All right, welcome. In this explainer, we are going to break down the single most powerful force in all of commercial real estate, interest rates.
So let's just jump right in with a question that really gets to the heart of it. How is it possible that a tiny little 1% change in interest rates can completely make or break a billion-dollar deal? I mean, the answer to that is the key to understanding this entire market.
So here's what we're going to walk through. We'll start with the basic concept, what I call the rate seesaw. Then we'll get into the actual math, how deals get squeezed, why that causes entire markets to freeze up, who the winners and losers are, and, maybe most importantly, how you can actually play it.
Okay, first up, let's nail down the single most important concept you need to get your head around, the rate seesaw.
It's honestly the best way to think about it. It's this powerful inverse relationship. Just picture a seesaw in your mind. On one end, you've got interest rates. When that side goes up, what has to happen to the other side? Property values. Well, they almost always go down. It's like the law of gravity in commercial real estate. Okay, so why does this happen? What's the actual mechanism here? Well, to get that, we have to look under the hood at the math behind how these properties are valued. And it really all comes down to two key ideas: cap rates and discount rates. First up is something called the cap rate. And really, all it is a super quick snapshot of a property's potential return. You know, if you were to buy a building with all cash, no loan, the cap rate is basically your annual return. It's a simple but really powerful tool investors use to size up a deal.
Okay, and this is where the rubber really meets the road. Think about it. In a world where you can get a super safe 2% return from a government bond, a 5% return from a property, that looks pretty darn good. But what happens when that same safe government bond is now paying you 5%? Well, suddenly that 5% from the property doesn't look so hot. Investors are going to demand a higher return to justify taking on the extra risk, and that pushes cap rates up, which, because of the math, pushes property values down.
The other side of the coin is something called the discount rate. Now, this one can feel a little academic, but stick with me, because it's actually super important. It's simple, right? A dollar today is worth more than a dollar 10 years from now. Well, the higher the interest rate, the less that future dollar is worth because you're missing out on more potential earnings right now. So when rates go up, all that future income a property is expected to generate just becomes less valuable today, which, you guessed it, pushes down the building's overall value.
All right, enough with the theory. Let's talk about what this looks like in the real world when someone is actually out there trying to buy a building. This is what we call the squeeze on deals.
So let's play this out. Imagine there's a property, and it makes a nice, clean $1 million a year in income. You want to buy it, so you go to the bank for a loan. How much are they going to give you? Well, that is going to depend almost entirely on the interest rate, because the rate dictates how big your mortgage payment is. And here is the absolute kicker. When the interest rate is 4%, a bank might lend you, say, $13.5 million. But if rates shoot up to 7% for the exact same property with the exact same income, they're only going to lend you about $10.2 million. That is a massive, massive difference. I mean, just let that sink in for a second. A 3% jump in interest rates just vaporized nearly a quarter of your buying power. So now what? You either have to magically find millions of dollars more in cash, which most people can't do, or you have to offer a much lower price for the building. That is the squeeze, right there in action.
So what happens when this kind of squeeze starts happening to deal after deal all across the country? Well, you get these huge shock waves that ripple through the entire market. This is when markets start to freeze.
What you get is this classic standoff. You have sellers, and they're all stuck thinking about the price they could have gotten 6 months ago when rates were low. But the buyers? They're living in today's reality. They're looking at today's high rates, and they can only pay what the new math allows. You end up with this massive gap between what sellers want and what buyers can pay, and the result? Nothing. The market just grinds to a halt. Total gridlock.
And honestly, it gets even worse. Think about all those properties that were bought just a few years ago with these super cheap 3% loans. Those loans aren't forever. What happens when they come due in a few years and the owner has to refinance at today's much higher 6 or 7% rates? If the property's income hasn't grown enough to cover that new, higher payment, the owner is in serious trouble. This is the refinancing risk ticking time bomb that everyone is talking about right now.
But here's the thing you have to remember. Not all properties are created equal. Some sectors get hit way harder by rising rates than others. So let's quickly break down the winners and the losers. And you can see here there's a really clear pecking order. Right at the top of the uh-oh list are new development projects, right? They're a long-term bet, they use a ton of debt, they just get hammered by rising rates. But then you go all the way to the other end of the spectrum, you have things like self-storage, where owners can raise rents pretty much monthly to keep up, or medical offices with super stable long-term leases that provide a predictable income stream no matter what the Fed is doing.
All right, so given everything we've just talked about, what do you actually do? How should investors be playing this market? Let's get into the strategic playbook for this high-rate world.
Look, if you're a buyer and you've got cash on the sidelines, this is your moment. This is when you go hunting for deals from those sellers who are feeling the squeeze from that refinancing risk we talked about. The game isn't just about buying and waiting anymore. It's about finding properties where you can get in there, roll up your sleeves, and actively create value by growing the income.
But if you're on the other side, if you're a seller, yeah, it's a completely different story. If you're lucky enough to be sitting on a property with a great low-rate long-term loan, you can just be patient and wait it out. But if you have to sell, you might need to get a little creative, like maybe offering to finance part of the deal yourself just to get it over the finish line.
And finally, if you are a current owner, it's all about defense. It's really a simple three-step playbook. 1. Lock in good fixed-rate debt whenever you can. 2. Don't have all your loans coming due in the same year. And 3. Focus like a laser on operations to squeeze every last dollar of income out of your properties. That income is your cushion.
At the end of the day, it all boils down to this. Interest rates aren't just some small factor that affects commercial real estate on the edges. No, they are the whole game. They fundamentally reshape everything from valuations to strategy. Understanding them isn't just a good idea, it is absolutely critical to survival.
And that really leaves us with a big question, doesn't it? We are clearly in a new, higher-for-longer rate environment. So, where are the smart investors going to find the next great opportunities? Because one thing is for sure, every single time the market shifts this dramatically, new winners emerge and new fortunes are made.